Warren Buffett made some drastic changes to his portfolio recently. He's down to $267 billion in investments, but over $350 billion in cash. Most of that likely short-term treasuries. What's also interesting is that he completely eliminated his holdings of the US index. You can see at the bottom below Citigroup, SPY sold 100%, VOO sold 100%. They weren't large holdings, but it's interesting nonetheless. In history, Warren Buffett has only sold for 4 reasons. Number 1, he's found something else to buy. That doesn't seem to be the case unless you include Occidental Petroleum. 2, he loses confidence in management of the business. Then he'll get rid of the business. If he loses confidence in the economics of the business, he'll also get rid of the business. The last reason that Warren Buffett typically uses to sell, I have not seen very often. The first I experienced during the dot-com boom of the 90s. Warren Buffett was selling because he couldn't find anything to buy. The last one I read about, it was the Nifty 50s, 50 of the most popular blue chip stocks that went on a massive bull run in the 60s. On the surface, it looks like Warren Buffett is timing the market, but he's never timed the market. He spends time in the market. What happens is his operating business and investments throw off a lot of cash. If he can't find a sensible way to deploy it, it will build up. Adding to this, as businesses in the portfolio become overvalued or the economics become unfavorable, he'll also get rid of those. He's also mentioned another metric called total US stock market relative to annualized GDP. Stock market value to country's GDP. Coincidentally, that is at an all-time high at over 200% today. As I mentioned before, I've only seen this happen during the dot-com boom. You can see it on this chart that tracks it right before everything collapsed in the tech wreck, the 60s, and I believe that is when Buffett, for the only time in his partnership, Buffett partnership, liquidated his holdings and returned cash to shareholders. His reasoning being, I can no longer find rational ways to deploy capital. This does not mean that you time the market. Time in the market is the most important thing. However, it also doesn't mean that you should jump in at any valuation. You need to be more careful now than before. Always, always, always look at the downside because the upside takes care of itself. Keep your emergency fund topped up and your asset allocation appropriate. Learn the lessons about money that a bull market can't teach you. Download my free newsletter link off the bio. Good luck. Take care.